Good afternoon. It's Brett here, directors. Thanks for joining today's live. So today, guys, I wanted to talk about refinancing. I'm sure many of you are starting to think about this, given the fact that interest rates are starting on the decline. We've been long awaiting this in the last, couple of years as rates have been on the upward trend, now seeing the decline. But I think with refinancing, there can be so many things we want to clarify and oftentimes some myths out there, such as, oh, it's super expensive. Or we've often heard the old adage, you got to wait for rates to come down 2% before it makes sense. Not necessarily true. And then, of course, the timing, how much cash you need, things like that. So I wanted to help address quite a few things under the vein of refinancing today to hopefully provide some clarity for you. So first and foremost, what is refinancing? So essentially, refinancing is redoing a current mortgage to a new mortgage, simply put. So, you may have taken out a loan, a year ago or 10 years ago. Doesn't necessarily matter. You currently have a loan on your home. You want to redo that loan for multiple reasons. Whatever that may be, you're refinancing that into a new mortgage. So it is replacing the old loan with a new loan. Now, there's a couple of different general reasons. The first type of refinance is called a rate term. And what that means is you are refinancing for the purposes of adjusting the rate or the term, or potentially both. So for example, you have a 7% rate, you want to refinance to lower it down to a 6% or 4%, whatever those rates may be, you're adjusting the rate. Or you have a 30-year mortgage that you want to adjust to a new 30-year mortgage. Say you're a year or two in, you're going back to a 30. Or hey, I want to go down to a 20-year, somewhat of an adjustment of term. So that's that first mortgage, probably the most common out there for most clients. Hey, I just want to take advantage of a lower rate and a lower payment and save both monthly cash flow and overall interest. Now, the second type of refinance is deemed a cash out. Now, what that may be is simply taking some of your equity out as part of the refi. Now, that can be in conjunction with adjusting rates and terms as well. But let's say you owe on a house $400,000, but you have a lot of equity and you want to do now a $500,000 mortgage. Not only could that allow us to adjust the rates and the payments and the terms, but that could get you $100,000 in cash. Now, that can be used in multiple ways. Some folks just want to put the cash in the bank for a future purchase or other things. But a lot of clients use that as debt consolidation. I want to take this equity and help to pay off credit cards or a car loan or something that's maybe more expensive in either interest or in cash flow. Now, one other major reason people do cash out is to improve their property. I want to do a remodel, or I need to do some updates or some just simple repairs. So a lot of different ways to kind of look at that. But again, those two buckets, a rate term and a cash out refi for us. Now, the benefits, again, I touched on those: lower interest rates, reducing our monthly payment, reducing the overall interest we pay on the term of the loan, and tapping into equity. So those are kind of typically the main different benefits clients are looking at to decide, is this going to make sense or not for us? So now it dives into, okay, I'd love to lower my rate or pull cash out. When do things make sense? So again, going to be a couple of different versions here, but let's attack first and foremost a rate term refinance. Let's say, again, you have a 7% interest rate today. A lot of clients go, I've heard that saying, you got to wait 2% for it to make sense. That has been around for a long time, guys. And I think if we think of when that originated, loans were maybe 100,000 or 200,000. So again, a 1% savings was not that significant. Now, when we have a lot of loans that are $500, $800, $1 million, well, 1% reduction is pretty significant. So here's how I like to analyze it for us, guys. I think it's very important to truly look at what is my interest savings versus my cost. Because in theory, if you could drop your loan 0.25% and it was 100% free, that absolutely makes sense, because it's instantly savings with zero cost. So I like to help clients analyze that for us. So let's run through a very quick scenario. Let's say you had a loan where you could refinance, but the total cost of refinancing was $5,000. And that helped to reduce total interest or monthly payment by $200, a month. So in that case, we look at it and say, okay, $5,000, I'm reducing it by $200 a month. Well, that would take me 25 months or a little over 2 years to break even. Now, if you're going to keep this home for 30 years, you would eventually make sense. But I like to always think, how long may I keep the home or keep the loan for? So not saying that's a terrible option, but I like to really look at a shorter break even. Let's say now we're looking at an option where, hey, that same $5,000 in closing fee saves us $500 a month. Well, now we're breaking even in 10 months. So you can see the difference there, guys. I think the rate is one thing, but again, if we have $1 million loan and we are dropping it even 0.5%, that's $5,000 a year. So again, I think there's perspective. So again, I love to look at that break even number. I think the shorter the break even, the better. Each particular scenario is going to be dependent on the client. How long do we think we'll be in the house for? How long until we think we may do another refinance? And that's somewhat market driven as well. But I think that break even analysis is one of the number one things to focus on to help see, does this make sense? And then you consciously know how quick you're recouping those cost savings. So that's that. Now, if we're looking at a cash out refi, a little bit different style. So for some clients, it might make sense immediately because you just need the cash, whether it's for, an important purchase or unfortunately a divorce settlement or different things of that sort. But for so many clients, it could be very simply looked at, hey, if I'm refinancing and I'm even keeping my interest rate close to where I am now, but I'm paying off 30% credit cards, guys, that typically can make great sense for you. Because if you're borrowing a mortgage at 6%, paying off 30% debt, not only is that going to improve your cash flow, it's going to dramatically reduce the interest. So I think in those scenarios for a cash out, it's looking at what's the opportunity cost of the debt I'm either paying off or of the cash I need to get for another piece. Hey, for example, improving the property, things of that sort. So we can always help to run those numbers, but that's going to give you a couple of reasons of how to analyze where things are. So the other thing for us is shorter term loans. I think traditionally the number one focus for most clients is how can I lower my payment? And I absolutely appreciate that. Improve the cash flow, pay less interest. But I think the other version of a rate term refi is shortening the term of the loan for you. Now that again, we all know the benefit, right, of paying a little bit extra on any loan, how much that compounds over time. So for example, if we look at a 30-year mortgage and a 15-year, you may initially think, hey, that 15-year costs twice as much because it's half as long a loan, not even close. And it's because of the compound power of interest. So that 15-year is definitely more than the 30, but not even close to double the payment. So I think it's an interesting mindset for a lot of clients to look at. So we love running numbers. I have clients now where we're refinancing from a 30-year that they're maybe 1 or 2 years into. So they have 29 or 28 years left, and we're refinancing to a 20-year. So not only is their interest coming down, now their monthly payment may be similar, but they just literally cut off 8 years of their loan or 9 years of their loan. So I would love to encourage, thinking about that as well. Is that cash flow important for you? And if so, that can be a perfectly great reason to refi. But also, if you're comfortable making your payment, maybe the focus should be, let's dramatically drive down the interest expense and how fast I pay off my loan while leaving my monthly cash flow roughly the same. So again, there can always be a combination here, but that's something that's huge for clients. Even if it's to the tune of a couple $100 a month, I've had folks, well, that doesn't add up to a ton. It's only a couple hundred. Well, guys, if you simply added that to your mortgage payment, you may now cut off 5 years. Well, 5 years of mortgage payment is a ton of money. So there's some different perspective there. So something, again, I love diving through with clients, helping to analyze, but there's a few different ways to approach a refinance and how to look at it. So let's dive through a couple mistakes real quick. One could be kind of trying to time the market perfectly or waiting too long. The one thing we all know about the stock market, the bond market, mortgage rates is we don't know at all how it's going to be. Now, there's definitely trends and we can forecast, but no one can ever 100% know the future. So again, I think the key piece on refinancing is we should be patient to wait till it makes sense, but we can't be expecting something that's unrealistic, right? Or waiting so long we're missing out. Remember, if we continue waiting forever to refi, we're not taking advantage of all that savings. Also, it's okay to refi more than once. If we have a super short break even, perfectly fine if we say, hey, it makes financial sense to do it today. I have a super short break even of 6 months. Well, great. Doesn't matter if we want to refi again in 12 or 18 months if the market keeps giving it to us. So there's some tactful ways we can say, let's take advantage of what we got today and immediately save, but have such low closing costs that if the market continues to go down, we don't have guilt. We're not leaving any money on the table to refinance again or even again. So there's some strategies there. So don't over forecast the market or wait too long to take advantage if the numbers pencil. Number 2, focusing on just the cash flow. And here's why I say it. You will see a million different ads out there of super crazy low rates, and those are available, but they have significant fees. Here's the kicker though. Almost any lender, ourselves included, can roll those into the loan for you. You're still paying it, guys. You're paying it at some point in the future when you sell. So you want to be very cautious to not just get hyper focused on, hey, I can get this great rate and it lowers my payment $500, and not realizing how much is padded into your loan. Even if you don't pay that in cash, it's still into your loan. So we want to really focus on, I love the ability to not have to have clients come with cash. But if we roll in fees, how much is being rolled in? It's still a fee. You got to analyze that and make sure you're not padding tons and tons into your loan. That's just going to be an expense you pay down the road, kind of robbing Peter to pay Paul in a sense. The third kind of mistake to avoid is if we're looking at, just refinancing, we obviously want to lower the mortgage. That's great. But remember, guys, the goal is here to help you out financially. And what I mean by that is look at your overall debt structure. It's a very interesting dynamic when I talk to so many clients of, hey, Brett, I want to put a ton of money down, or I want to refund my mortgage and I don't want to, bump the balance up. I love that mindset. But on the flip side, they got 30% credit cards over here. Guys, the goal is how do you have less overall expense? So it's interesting how we see kind of mortgages in a silo of debt. So there's plenty of ways to structure it. And I'm not saying it's always right to roll everything in, but it's an important conversation to have to say, what is my overall debt structure, the overall interest expense I am paying, and what's the best way to minimize the interest and start to attack that debt and bring those balances down as quick as possible. So I would just encourage you to look at that as a package to make sure you're making the right decision in regards to refinance for you. So there's kind of three main things. Now, okay, we've talked through why to do a refi, what are some of the key things to look at, how to analyze. Hey, if this makes sense, what's that next step? So really the next step is chatting with a lender. Feel free to reach out to us or a particular lender to say, hey guys, what are the current offerings for my scenario? Remember, if you're looking online and see a rate, that's like looking and saying, what's car insurance? Well, guys, every single interest rate, just like car insurance, is based on your particular scenario. What's your credit score? What's your debt to income ratio? What's your loan to value ratio? What are the particulars of your loan? So again, don't get confused by that. Reach out to a reputable lender, have them help run those numbers for your particular scenario. And again, remember, it's not a one size fits all. You really got to know what are your individual goals so that refinance is structured the proper way. Potentially do a little bit of research on your home value. We all can look at Zillows and Redfins and things like that, but maybe narrow in. Have there been some sales in my neighborhood the last, 3-4 months? Potentially chat with your real estate agent that you originally worked with, see if they can work some comps for you. But having a good feel of what your value is will help a lender properly run numbers up front for you before paying for an official appraisal. Number 3, work on your credit, or at least keep it good. Remember, credit is a key factor to helping on a mortgage and getting you the best terms. So if you're thinking about refinancing or getting closer as these rates come down, I have a lot of clients now that are always trying to improve their credit, but maybe a little more focused the next 2 or 3 months. Pay those credit cards down a little bit. Make sure there's no late penalties to see, hey, how can I boost that score as high as possible before I officially start that refi to once again help myself get the best terms. And then again, set up a strategy call, as I kind of alluded to. It's key to really dive into the individual goals of your personal scenario and what you want out of this refi to make sure you're not being thrown into a one size fits all, and it's actually going to work the best for you. So I think that's huge. So ultimately, guys, refinancing is huge. It's so rare a client ever keeps a loan for 30 years because of the market cycle. It's a great thing to say, hey, we may be in a cycle, rates are down, let's lower that. I might be in a cycle where, hey, I can afford a little higher payment. I want to pay my loan off faster. Or I'm in a cycle where I need to pay or take some equity out to improve my house, to buy another property, to expand my portfolio, whatever it may be. It is such a common thing. Feel free to reach out. We're happy to chat through details, talk strategy, and ultimately help you on the overall endeavor of paying less interest and paying the debt off. So thanks for the time today, guys, and feel free to reach out anytime for us.